Hey all, my name is Paul Borosky, and I am the owner of Quality Business Plan, as well as the author of The Beginner's Guide to Understanding Financial Statements and Financial Ratios, which I have published on Amazon.com. And what I'd like to do today is to give you all some financial analysis tips for Nike's 2021, their cost of goods, and their current ratio for the last 5 years. So the way the video is going to play out is I'm going to go ahead and give you all some tips and tricks about, well, Nike's cost of goods for the last 5 years, identify some trends, good, bad, or indifferent, and then we'll dive into current ratio, explain what it is, and their trend for the last 5 years as well. From there, I'll go ahead and introduce my company reports that I do write for Nike and other public companies. I write financial reports from, as well as beginner guides for to help in analyzing the financial statements for this organization as well as others. All right, so with that foundation set, let's go ahead and zip through this little PowerPoint presentation I've got concocted for your listening and viewing pleasure. All right, so first and foremost, when we are analyzing cost of goods line item, whether it be for Nike or another organization, if we just look at the cost of goods, we'll see that Nike's cost of goods were $19 billion in 2017, went up to $20 billion, then $21 billion, stayed about $21 billion in 2020, and then jumped up to $24.5 billion. Only thing that tells us is that their cost of goods is going up, except for 2020 and 2019, kind of stayed the same. Without some kind of metric or something else to compare it to, it's not going to do us a whole heck of a lot of good. So what I like to do is compare it to the cost of goods as compared to revenues. Specifically, what I'll do is I'll divide the cost of goods as compared to revenues, and it's going to give me a percentage. And from this percentage, I can then tell how the organization is doing in managing their cost of goods in terms of revenue. No, so for this example, cost of goods in terms of revenue is going to be 55.4% in 2017. Their cost of goods went up as compared to revenues in 18, went down a little bit, went up a little bit, went down a little bit. So this trend of up, down, up, down, up, down, and we're really not having a whole lot of fluctuation. It's just going a little bit. This tells us that actually the organization is doing a real good job either controlling their cost of goods. They're doing a good job in negotiating the raw material costs for their sneakers and their clothing lines. Or if their raw material cost increases, they're bumping up their sales price to cover it, to make sure that their profit margins, their gross profit margins are staying the same. So in my most humble opinion, this type of trend right here is actually a good thing because it shows consistency in the management. Next thing I'm going to compare is going to be the average growth for the last 5 years in terms of revenue as in terms of cost of goods sold as well. So for this example, revenues, their growth rate on average for Nike was 7%, whereas their cost of goods sold on average was about 6.8%. So this tells us that their growth rate for revenues is growing faster as compared to their cost of goods sold, which means this is in a 5-year time span, their gross margin has grown ever so slightly, but still it was definitely a trend in the right direction. So overall, Nike's doing a real good job with negotiating or increasing their prices based on the cost of goods sold. All right, next is going to be the current ratio. The current ratio, all that is the formula for it is current assets divided by current liabilities is going to give us the current ratio. If the number is 1.0 and above, that means that the company has enough current assets to cover the current liabilities for the 12-month time span. Also, that means the company should be liquid for that 12-month time span as well. All right, so in this example right here, what we're seeing here is if we divide Nike's current assets, 16 billion, divided by the current liabilities, 5.4 billion, we're coming up with a current ratio of 2.93. This means they've got almost 3 times current assets as compared to current liabilities. Some schools of thought are going to say, wow, they're doing a fantastic job because they have all these current assets and their current liabilities are so low that they're going to be solvent, forever and a day. My most humble opinion is that this tells me that the organization is not optimally using their short-term assets. They're carrying too much inventory. They might be carrying too much cash. They're carrying too many short-term assets as compared to current liabilities. A better trend to do would be, if they're carrying on too much cash, kick out that cash in dividend payments or reinvest it in property, plant, and equipment. Move some of this money or some of these short-term funds into long-term investments, or kick them out to the investors if you have no current projects that are going to make you money. But keeping too many current assets as compared to current liabilities is inefficient use of the current assets, and that's a bad thing in my most humble opinion. It's not as bad as being not having enough money to cover them, but it's still inefficient nonetheless. So with that foundation, the organization did do a good job with pulling down their current assets, their current ratio, for the next 2 years, ending 2019 at 2.10. However, boy, they got this little thing that they want to do, is to keep their current ratio way the heck up there, and so the trend was reversed in 2019 to 2020, and it went back up to 2.48 to 2.72. The consistency is not there. It's way too high. The organization needs to get on the stick, and they need to do a better job with managing their current assets. It's as simple as that. All right. So with that said, hopefully my insights into taking a look at these two, the line item and also the current ratio, was helpful. If you do want to go ahead and pick up one of my company reports, I do have them for sale on my website, qualitybusinessplan.com/public company financial reports. I have financial reports and beginner's guides for both Nike. I've got it for Apple and about 15 to 20 other public companies throughout the U.S. All right, so hopefully this information was helpful, and just to wrap this up with a little bit of experience about me, again, I am the author of Beginner's Guide to Understanding Financial Statements and Financial Ratios. I've published it on Amazon.com. If you're looking for a good guide for understanding the basis of financial analysis, definitely pick it up. And then also, I am an adjunct professor and subject matter expert for both business and finance. I teach finance courses, design finance courses for a local college. So I'm pretty experienced in the financial realm. And then finally, to wrap this game up, is going to be when you're doing your financial ratios and you're calculating financial ratios, be careful with your formulas. Some of the formulas that I talk about might be a little bit different than some finance books or how other finance instructors teach. So just be cognizant of the ratios, of the formulas used for the ratios. And then from there, financial analysis, the beauty is in the eye of the beholder. If I say something looks good, for example, Nike's current ratio is way up there, I think that's a bad thing. Somebody might say, wow, this is phenomenal. Love it when one of a company's current ratio is so high. It just gives me the chills. Some people like it, some people don't. I'm not a big fan. All right, so and then finally, if you're looking for a guide for a financial analysis, check out my website, publicqualitybusinessplan.com, public company financial reports. I've got reports and beginner's guides for several different companies. All right, so hopefully y'all liked the video. If you did, give me a thumbs up on YouTube, and then as always, have a great day. Thank you.